Now, welcome back to session 20 of the International Conference on Inclusive Insurance. It's now day 5, and today we'll be talking about solutions for the future. Welcome all the panelists. Welcome Nicolas Byers, Research Associate of Sinfree in South Africa. Thank you, Nicola, for facilitating that, and we cross fingers that your electricity supply stays on so that we don't lose you. Now, I'm very excited about this session here. We talk many times that we need the right legal framework. So the insurance supervisors play a crucial role here. And thank you for putting that panel together. Now, before we start, let me walk you very quickly through the housekeeping slides. As always, please mute yourself unless you're speaking. We have this afternoon Spanish interpretation available, so click on the globe button and then you can choose the language that you want to listen to. This session is being recorded and we'll make it available on the conference website. We'll also make presentations available on the conference website. Many presentations have already been uploaded, so just go to the conference website. For the session, if you have a question, and I ask you to have many questions, please use the Q&A function to put your questions in. If you have just a comment, then you can put that in the chat box. And if you have any technical issues, please message the MIN executive team via the chat. Now, welcome all the participants from around the world. Good morning, good evening, good afternoon to everyone. And I hand over the microphone to Nicola.
Great. Hi.
Nicola, I think we have lost her, so she's probably trying to log on again. And we just wait a few more minutes.
Fantastic. Can you see and hear me, everyone?
Yes. Now, welcome back.
Fantastic. Apologies for that quick interruption. Very happy to be back with everyone.
Just send me your notes in case you get lost again. Okay. So I'll leave and I leave the floor.
Thanks, Dirk. Thanks very much. All right, everyone. So innovation itself can create opportunities. It can enhance efficiencies. It can increase competition, drive scale, improve the reach and value of financial services to consumers. But with innovation also comes risks. And due to the very nature of innovation, it's often not actually accommodated within existing regulatory frameworks. So today, with the wonderful panel here assembled in front of you, we will be discussing how insurance supervisors have gone and can go about choosing and implementing a fit for purpose and fit for context combination of tools to regulate for responsible innovation. So as Dirk so kindly mentioned, my name is Nicola Byers and I work as an associate at Sinfree. I'd now like to invite the rest of the panelists to introduce themselves. I think we can start in alphabetical order, if that works. So Nigel, you can go ahead. Thank you.
I was hoping N was towards the end of the alphabet. But yeah, I'm Nigel Bowman. I'm an independent consultant actuary. I focus on inclusive insurance and have done so for many years now. It's a real area of passion for me. And before moving back into consulting work about a year ago, I was one of the co-founders at Inclusivity Solutions. So designing and building digital inclusive insurance solutions for large aggregators of customers like banks and telcos. And in my spare time, I also chair the International Actuarial Association's Inclusive Insurance Virtual Forum. There's quite a mouthful for you, but yeah, we've done some really nice work, I think, and we'll be sharing a little bit of that, which we think is quite relevant for supervisors. Thank you, Nicola.
Great, thanks, Nigel. I think Yulin, you can go ahead.
Thanks, Nicola. It's really nice to be here. So my name is Huilin Chu, and I am an advisor at the Access to Insurance Initiative, which I think a lot of you know is the implementation partner of the International Association of Insurance Supervisors, another mouthful there, I must admit, or IAIS, on financial inclusion. And my areas of specialization at the A2II are consumer protection or market conduct, regulatory impacts, and as Nicola, you well know from our joint project, supervisory key performance indicators. Previously, I was at the Central Bank of Malaysia, where I worked in the financial sector development departments. I looked at our policy strategies to develop the banking and insurance sector, and I was also the policy lead on developing inclusive insurance. So this is a topic that's quite close to my heart as well. So that's my experience, sort of in a nutshell. Back to you, Nicola.
Thanks, Yulin. Appreciate it. Elias, I think you can go ahead.
Right. Thank you very much, Nicola, and also thank you for the organizers for inviting me to speak. I'm Elias Omondi. I work for the Financial Sector Deepening Africa, FSD Africa, as a senior manager in charge of risk regulations. And ideally, my work is to lead the development and implementation of programs that work to improve the enabling environment for risk markets in Africa, with an intention to drive systematic change in the insurance market and other risk management instruments. So I work very closely with regulators across the region in Africa, and ideally FSD Africa is a development agency body that is basically supported by the UK government. Now, on my previous experience, I used to work as an actuary at the Insurance Regulatory Authority of Kenya, whereby I was really dealing with development of regulations and rules that do support both prudential supervision and market development, but also have supported market innovation and designing and testing innovative solutions through the formulation of the regulatory sandbox in Kenya, but also through leading the process of setting up a BIMA lab, ideally a regulator-led InsurTech accelerator platform, and definitely we'll be able to talk about that much more. So I'm happy to be here and looking forward for this to this engagement. Thank you.
Thanks, Elias. And then Pratasio, last but definitely not least, I think you can go ahead.
Okay, thank you very much, Nicola. My name is Pratasio Sande, Director, Planning, Research and Market Development at the Insurance Regulatory Authority of Uganda, a directorate I have been heading for the last 8 years now, before which I was in academia. So I moved from academia to insurance regulation. And in my role as director, I have also prevailed over a number of market development initiatives. When I look across, I have worked with Elias on some projects. We have worked with Nigel and you, Nicola. I think we've met and interacted on a number of market development interventions, which I would be glad to talk about, share experience about Uganda. I'm a chartered insurer of the Chartered Insurance Institute of UK. And I'm also a student in my final stages of my doctorate program. Thank you.
Great, thanks very much, everyone, and very, very happy to see you all here and to participate in this panel with you here today. So I'm going to start us right off by talking a bit about insurance supervisors' objectives and mandates, which have traditionally focused on prudential supervision or on supervising the stability of the market. And while some have expanded a bit to now encompass consumer protection, this is something that we've seen a recent shift in. So Yulin, I'd like to start with you. And in your experience as someone working with the A2II as their technical lead on regulatory impact and on market conduct, what have you seen in terms of how the mandate of insurance supervisors has shifted over the past couple of years? and how have they responded? In your opinion, what has worked and what hasn't?
Yeah, thanks, Nicola. So indeed, as you say, the core mandates of insurance regulators, or even the reason that insurance regulators were set up in the first place, have always been to ensure financial stability and the protection of policyholders. So now, over the years, this sort of slowly evolved. The financial crisis back in 2008 prompted a little bit of soul searching as to what really went wrong in the financial sector. And basically, there was really a renewal of emphasis on the importance of looking at how business is conducted by financial institutions and how they ensure that consumers are treated fairly. So this commitment is sort of captured at the global level, for example, in the GPFI High-Level Principles on Consumer Protection from 2011. So in the insurance world, first I'd like to sort of caveat here that fair treatment of consumers in the insurance world has been the principles have been there for a really, really long time, at least since 1999 from the documents I've seen. But before that, I wasn't around for that. But at least in the insurance world, so this sort of renewed focus on consumer protection really it revolves around how insurance is sold, explained, serviced, how claims are paid out, how consumers make complaints. So it's really about how consumers are treated throughout the whole customer journey from end to end. And I think today it's really pretty much a given that supervisors at least have two jobs, right? Financial stability for one, and consumer protection. And there's a 2017 World Bank survey that sort of did, among other things, ask supervisors about the mandates that they have. And 27 out of 33 supervisors who responded to the survey indicated that they have a market conduct mandate. So now that's kind of the core mandates of supervisors. And recently, what we're also seeing is a shift into a sort of more market development kind of approach. What we're seeing is that it's really quite a mainstream objective for many emerging market supervisors today. So in that same survey, 17 out of 33 supervisors have a market development mandate. And to be honest, I think it's quite hard to say when market development really started becoming a thing, that was sort of really entrenched in the mandates of supervisors. So some countries like India, for example, started decades ago. And from my experience in Malaysia, Bank Negara Malaysia, or the Central Bank of Malaysia, it's a combined central bank and banking and insurance regulator. And a development role was already recognized since very early post-independence in 1957, where we realized that bank branches were concentrated in the cities and many Malaysians didn't have access to basic banking accounts. So I think from here, generally, I feel that this sort of developments, market development mandate, it really came from a general self-awareness among emerging countries that, like we need an active, intentional approach in order to grow and develop the markets, the insurance markets, to fix issues related to our core mandate, to catch up with the rest of the world. Just the fact that there's a problem there, and in a way, someone's got to take responsibility for it. So which is why we see that a lot of supervisors who don't have sort of explicit mandates for market development in their law, they do it as well. And I think a second aspect to this is also that insurance supervisors sort of, really come forth to support economic development and resilience of their country. So meaning looking at things like economic inequalities, enabling sort of progressive and inclusive growth, contributing to development challenges such as climate change. And part of this sort of call to action has come from a sort of a top-down way. A lot of governments have been pushing their regulators to sort of align with sort of the national strategy on, let's say, disaster risk management, and leading to a drive to, let's say, come up with solutions like agricultural insurance. So this all leads me to the final and fourth sort of mandate area, which is also the most nascent, which is that some insurance supervisors are also increasingly engaging in sustainable development issues, most notably climate change as well. So, I mean, in terms of your question as to has it worked, what's the responses been like? I think the main thing that we've seen from A2I point of view is that these mandates have really been a very strong catalyst for action. So driven by these sort of mandates, supervisory mandates, many emerging market supervisors are designing and implementing policies that isn't just about preventing harm and preserving stability, but rather actively encourage innovation and enable development and sort of turbocharge market development in the insurance sectors. And we also see that These mandates are really crucial for supervisors to be able to take action, to set up a team, to dedicate resources, to build capacity in order to do active work on something. And very importantly, actually, to get buy-in from policymakers and industry stakeholders as well. So, and I think as a sort of a final note to your question, I want to say that as a whole, we've seen sort of emerging markets insurance premiums outstrip growth of premiums in developed markets in the past decade at least. But, you know, I mean, from a supervisor's point of view, I think the question I want to put out there is it enough to say that insurance markets are growing simply by looking at insurance premiums? Are regulators satisfied with that as a measure? Are there other aspects that we should measure when it comes to market developments? Is there data for that? I think that's sort of the open question that I want to put out today.
Yeah, thanks very much, Yulin. I think we're definitely going to be touching on some aspects of that later in today's session. So thank you very much for raising that. I want to turn to you now, Nigel, though. As a development-focused actuary and someone who has worked on developing an innovative insurance solution and launched that across markets, have you, as a private sector player in this case, experienced this shift in supervisors' mandates, and has that been something that's filtered through from your perspective?
Yeah, thanks, Nicola. Yes, absolutely. I have absolutely seen it. You can see quite a bit of grey hair. So I've been around for a few years now, and yeah, I've certainly seen that shift of emphasis more towards market development. Not that the others are less important, but bringing market development emphasis alongside the protection of consumers, prudential issues, etc. And you know, I think the implication of that is that it really has started providing a more enabling environment for industry to be more innovative. And I guess that's part of the reason why we're seeing faster and faster growth in insurance premiums in a lot of these markets as well. So it's ultimately, I think, positive market development. Obviously, a lot of questions around whether that growth is having a positive impact ultimately, as Yulin says. But yeah, at least things are moving in the right direction and moving quite nicely. And two contrasting examples come to mind from my experience. The first, probably around about 10, 15 years ago, I was involved in developing a new investment product. And before launch, we had to get supervisory approval for the product. And the supervisor essentially insisted on putting certain minimum investment guarantees in place with a view to protecting consumers. So that's exactly what the market was doing at the time. Very used to doing that kind of thing. All investment products had those kind of guarantees. The insurer, on the other hand, felt that it was just way too risky to do it. The investment environment was not conducive to those kind of things. And it took a heck of a long time for the insurer to convince supervisor that, in this case, focusing on consumer protection in that way is actually not the right thing to do. So it very almost resulted in the product just not being launched to the market. And you know, I think that sort of illustrates the sort of older focus on that consumer protection and stability side to the detriment potentially of market development. And a more recent experience at Inclusivity Solutions, interestingly, that was actually with IRA Uganda. So a little bit of feather in the cap to Protazio and team on this one. Because it was a very positive experience. Inclusivity was developing a fairly innovative product, a broken bones product for border riders. So border riders, for those who don't know, are motorcycle taxis, and there are lots and lots of them in Uganda and a lot of other African countries as well. But I guess the novelty here was more the legal structure and the reinsurance arrangement in the back end. So it was quite different to how things would typically be done in insurance. So us at Inclusivity spent quite a bit of time with the RA, taking them through the structure, explaining the product, and together looking at the risks and the issues that could arise from it. And through that, we were able to address the concerns that the RA had around the product. And the product did get to market, but unfortunately, there were other issues which ended up the product being stopped fairly short after launch. But I think that experience really just illustrates the shift in mandates, and how supervisors are starting to think about being more accommodating to innovations, and so on. So in terms of how I think supervisors can create that enabling environment for innovation, just three things that come to mind. First is being open to these kind of new innovations. Secondly, and I think this is to me a really important point, is for supervisors to have the confidence that they can identify the big risks in these innovations, and then also be able to be confident that they can manage those risks, or that the risks will be managed in an appropriate way going forward. It's one thing to identify them, it's another thing to make sure that they are managed appropriately as well. And then thirdly, I think just engaging in an open way. As I experienced with the IRA a few years ago, that is really a very positive experience. And I think industry has a bit of blame to carry here as well. It works both ways. Don't just expect the regulator, the supervisor to be open with you. You need to be open the other way as well. So it goes both ways on that side. But yeah, those are the three things that I think are quite important. Just being open, having the confidence in your capability to assess risks and manage them, and engage openly as well.
Thanks very much, Nigel. I think that actually provides the perfect segue to the next section of our conversation. I'm going to request the MIN executive team just share the slide for that'll serve as the anchor for the next part of our conversation, which is around how supervisors can balance this evolving mandate. So their core mandates with this need to, on the one hand, foster development, encourage development and innovation, while making sure that consumers are protected and the market remains stable. So on the slide in front of you here, you'll see what we call affectionately the supervisor's toolkit. And what we unpack and what we hope to discuss further during today's session is the 4 clusters of tools that supervisors can implement in striking this balance between their different mandates. So on the slide, we'll see the enhanced communication, which goes from the industry and from non-participants as well. So innovators who are looking to enter the industry. So as Nigel just mentioned, this openness and this communication, that's definitely an important aspect, and something that doesn't necessarily strike one as part of the traditional supervisor's toolkit. Then we also see here on the slide the regulatory and supervisory tools. So on the one hand, evolving and adapting existing supervisory tools when it comes to, for example, product approval. And then on the other, responding to the new and emerging risks from innovation, such as protection of consumer data, for example. And then underpinning and feeding into is the monitoring aspect, which really speaks to updating monitoring and supervisory key performance indicators to take stock of the evolution in mandates while also keeping the core mandates in mind as well. So I'm going to turn now to you, Protazio. As I mentioned, proactive communication between the industry and the regulator from the regulator's side is part of this toolkit and can be a key part. So I'd like to understand a bit more about your experience at the Insurance Regulatory Authority, or IRA, in Uganda with communication. What has been the impact and how effective has this been, and what have been the benefits and the challenges that you've experienced in implementing these communication tools and this proactive engagement? Protazio, you're on mute still.
Okay, thank you very much, Nicola, for that very good question. Indeed, before I even answer the question straight away, traditionally, I think regulators were stuck in communicating between themselves and the regulated entities. I think traditionally that's what we have done across through a number of forums, In Uganda, we have always had quarterly engagements with the industrial captains. We have had quarterly press briefs to ensure that, people get to know what is happening. But when we interacted with the SEMFRI, I think I remember it was Niger and Nicola, we realized that there is a certain category of people that needs to be updated on the developments quite more than often, but they are not necessarily industry players, licensed industry players. And this brings in the aspect of innovation. We realized that there was an information gap. Insurance, we realize, is a very technical thing, known by a few, but there are also quite a number of challenges whose solutions we can find out. So we realized the need to proactively engage the non-insurance actors, the people with ideas but do not know insurance, but can provide solutions. One such tool that we have adopted with the support of SEMFRI was the quarterly newsletter. We have so far, I think we have just issued our 6th newsletter. SEMFRI supported us in designing the initial development of the first 2, but I'm glad that they also managed to build our internal capacity. From the 3rd up to the 6th that we have just issued, we have been doing most of the work internally. Now, in terms of reach, we are able to reach at least about 2,000 people via mail and close to 10,000 people via other social media platforms. Now, we usually get responses on mails. We get an average of 200 responses, either asking for more information on some opportunities in the sector, some challenges we have identified where we need partners, some upcoming events. That one gives us an impression that people are interested. And actually, as a result of these newsletters, we've seen a lot of proactive, again, engagement from outside to IRA. We have some modes of communication here. On an average, on a daily basis, we get about 50 inquiries, which was not the case before. We have inquiries of people wanting to establish agencies. We have inquiries of people having solutions and they want to be connected to the players. And I'm also glad to mention that because of that pressure, we had to come up with some framework. I think Elias mentioned the sandbox. We came up with sandbox regulatory framework. It is in form of a guideline. It's not yet a regulation, but we said, let's have something in place to accommodate the ideas and proposals of some of these people. And as I talk now, we have 2 firms in the sandbox trying to try out some ideas, and we see if these ideas can be nurtured into actual solutions for the insurance market. So I want to say that as a result of that proactiveness in communication, the gap between the regulator and the sector on one hand, and people with ideas but do not know exactly how to push these ideas to support the sector has narrowed over time. And we are optimistic that if we continue this way, we are likely to see new ideas come on board, new solutions come on board, and indigenous solutions based on real practical challenges. In terms of challenges, of course, some people don't have emails. I think this is a general problem. Internet, the cost of internet is still high, especially for budding innovators. People have just left university and whatever are cut off by internet. And where we are moving, in our plan as the authority, we are planning to start an innovation center, a resource center where we can allow young people to come in, access internet resources, build the ideas at the minimal cost possible. That's a plan in progress. We think maybe in the next 2-3 years, we should be having that center, which we shall allow free entry to the public to come and access low-cost resources, to develop the ideas further. Otherwise, at the moment, men are left out because of the constraints related to access to information. Of course, the other challenge is it's a delicate balance. It's a delicate balance, regulating, balancing between consumer protection, sector stability, and market development is, in my economics world, we used to call it a knife edge problem. So it's a task to the regulator to try and weigh options. There's times when we have said no. We ask these guys to go back and think again. And some of them feel frustrated that we are too hard. But again, we have another obligation to protect consumers. Some ideas sound too crazy to be even admitted in the sandbox. So that's another challenge, I think, associated with our mandate as regulators. We have to protect the policyholders. We have to ensure that the sector is stable, but at the same time, we have to promote innovation. But overall, we are seeing some positive improvement and positive response as a result of our productive engagements with both the players, but most importantly, the non-traditional sector players, where we see actually the true competition now is coming from.
Thanks very much, Protazio. I think you've now touched on quite a number of the aspects that we'll be discussing. So I want to turn now to you, Elias, to hear a bit about your experience when you worked at the IRA in Kenya, whether this was something that you found useful as well in terms of engagement with industry and non-industry players.
Right. Thank you, Nicole. And once again, I want to thank the organizers for setting this up. Yeah. So as you've stated, I've been working in the regulatory space for over 10 years, not only in Kenya, but I've had a number of engagements in a number of countries. So far, around 14 African countries, supporting regulators in a number of fields in terms of prudential supervision, market conduct, and also market development. Now, you've asked what has been the experience, and where I would want to start from. Being called a regulator is not the best thing. People view regulators as policemen, and there are some regulators even at the moment. If basically you get a call from the regulator's office, the first thing that you will be asking is that, what have I done wrong? So in terms of the evolution of regulation and how we've seen a lot of transformation from that particular moment, whereby basically getting closer to a regulator's office will be a bigger crime than you would want always to stay far away, to basically getting to what Protazio has been talking about, having that particular natural way of basically bringing together and making the regulator become very attractive to even the regulated entities is some work that has been done. Now, based on the experience and based on the evolution of how the market dynamics have been happening, one of the key things that I've seen is that regulators must remain agile and also must look at the way that they mitigate risk, particularly in the way they are applying their regulatory approaches on various fronts, be it on the prudential side to maintain market stability, be it on the market conduct side to ensure that consumers are well protected, and be it on the market development side, particularly when they want to bring in innovators and innovations within the market. Now, Africa faces a very unique, I would say, circumstance, because one of the key things that you look at an African regulator looking to do is that they want also to ensure that communities are protected, because the protection gap is very huge in Africa. Now, that increases a bit of vulnerability, particularly when you want to ensure that you are looking at various mandates that were mentioned by Hualin, that you want to push for people to be more protected within the space, but also with that, then it means that because of their level of vulnerability and also issues of financial illiteracy, then the regulator is basically faced with a very unique problem, because they want to protect this particular person that at one point cannot even understand some of the documents that they might be given to contend that I'm protected. So that agility must always be there. It's totally different from other regulators that maybe from developed countries. A regulator in a developing country must always remain agile. And one of the key things that out of the experience I've seen is that these regulators must always assess their regulatory parameter, and not only assessing the regulatory parameter, but always looking at ways in which they are going to update their parameters in a timely basis. So that requires the agility that I'm talking about. They need to respond to the changes fast, very quickly, in terms of enabling them to reach and to reduce that protection gap. They need to look at ways in which they're going to implement these new regulatory approaches within the regulatory parameter. The second component that I've seen, and ideally by looking at and working with the regulators across Africa and also working with ICII Kenya, was that the issue of capacity, particularly staff capacity, is a very important component. So how do these regulators continually build capacity in the new areas of expertise? Because there is an evolution. They're basically moving the moving target. It's not that a regulator in Africa will have a one target that is not moving. They're having a number of targets, and these targets are regularly moving. So ideally, it requires a lot of capacity building, and that requires, again, resources. So the challenge is, how will the regulators in Africa ensure they'll always have adequate resources and skill sets that are going to deal with these particular challenges, particularly when even it comes to innovation. So it's very important to look at how then these particular issues will be dealt with. Now, out of the skill sets and out of the capacity that we've seen organizations that have been trying to provide that. And currently I work with FSD Africa, and one of the key things that they look at is providing the technical expertise and the technical assistance to some of the regulators across Africa. Currently, we work with over 28 countries, and we basically provided up to around 130 regulatory policies that do support a number of regulators in Africa. The third component that I want to talk about out of the experience is how do they monitor the macro financial risks. Now, one of the key things that you will be able to appreciate is that when you talk about the financial systems in Africa, you'll get that in terms of the assets, we have a very thin line of investments assets that companies would focus on. We are also faced with a number of risks that also come out with some of these particular financial risks that we are talking about. So the key thing here is that there is need for regulators to monitor these risks that might materialize and basically affect the entire financial system. Now, how then do they do that? Importantly, I've seen, and we've worked, and with my experience at ICII, that required a very good system, a very good regulatory system. And SupTech and RegTech becomes a predominant factor to enable regulators to manage some of the risks that I'm talking about, because they need to get this data much quickly. They need to start detecting problems before these particular problems become major and might affect the entire financial system because of the systemic nature of some of the risks that might be there in the marketplace. So ideally, they need to have a very good system to manage that. In IRA, we did manage to develop what we call an electronic regulatory system that was an online platform that companies would have to submit data on real time to the regulator, and the regulator will be able to assess and manage that particular and basically analyze that data. Now, how many regulators have that particular capability? It's very few regulators in Africa that will be able to do that. But again, we've seen a number of tools being created across Africa to help them monitor and manage some of these particular risks. Now, Protazio has mentioned something quite important, and that is another level of experience that I want to share, is that there is need to develop open lines of communications, not only with the regulator, but also within other relevant authorities. Now, in Africa, we kind of face unique risks that might be cross-cutting across different regulators. You'll get that there's a product that has a lending component, a micro lending component that you might need to be talking to the central bank and the SACCO's regulator for that particular product to be taken in. So having that, what we call an open communication across relevant authorities is crucially important for some of the challenges that are highly faced in Africa, and also that do relate to insurtechs and fintechs within the region. Another component that I would want to share is that with the experience that I've had working with a number of regulators and also with the insurance regulator in Kenya, is that there is always an important factor to share learnings, because we don't need to reinvent the wheel, particularly on some of the challenges that a particular regulators manage to solve. Sharing of these learnings will provide a greater access to information that will enable authorities to develop across the region. And ideally, that also comes in with what I did mention earlier, having an open line of communication. I basically appreciate what ICII is doing around that particular component, whereby there is a lot of sharing across different regulators, and also looking at how then the regulators have a platform to engage with an intention of solving some of the challenges that are facing. To my last point, we also need to contribute to the greater international cooperation as African regulators. Now, one of the key things that I've seen is that there are very unique challenges in Africa. We are coming up with very unique solutions, and these solutions should be able also to kind of have an influence on the greater regulatory frameworks in the world. So for instance, we have what we call insurance core principles, right? They do provide some guidance notes. How then do we use this experience that we are getting from the unique challenges that we are basically facing in Africa to influence such kind of things? And how then do we also ensure that the effectiveness and the financial stability within the ecosystem and within the African continent is also influenced by some of this international practice? So there's need to have that greater cooperation across the continent, and also across the world, because there are a number of principles that are being put through at different sides of the world, and this is for the greater good of the insurance industry and also the financial system. So we need to continually cooperate. We need to continually contribute to the international practice, and that's where then we are going to solve some of these particular challenges. So definitely there's a lot that has been done out of the experience within the African setting. There's also a lot that needs to be done, but generally I can say we are basically making the right move. We are basically going to the right direction. We've heard of from Protazio that there is a sandbox in Uganda. There's also a sandbox in Kenya, and recently I had an interaction with the Ghanaian regulator, and they have also come up with an innovative insurance license. So this kind of brings together a number of approaches with an intention of ensuring that the regulators do provide the regulatory clarity that is needed by all these innovators and companies that would want to come into this particular ballgame. Thank you very much.
Thanks very much, Elias. I'm hoping you can hear me. Great.
Yes.
Great. Yeah. I think that very nicely brings me to my next question. You mentioned this this issue of agility and the necessity for the supervisory authority to adapt and to be able to accommodate these innovative developments. And the second category of supervisory tools speaks to the evolution of existing supervisory tools that on the one hand may entail some form of regulatory change, such as proportionality, where you have the introduction of tiered licensing requirements, but then also something around flexibility, of which we see the sandbox and the test and learn approach as being primary examples. So both you, Protazio, and you, Elias, spoke about the potential to use sandbox as a form of test and learn, which then speaks to this evolving existing supervisory tools. But I'd like to turn now to Nigel. In your capacity as chair of the International Actuarial Association, or the IAA's Inclusive Insurance Virtual Forum, you were, apologies, I think, just give me a second, my sound is giving me a bit of an issue. Hi, is it better now? Can you hear me?
We can hear, but there's still a bit of a kind of ticking noise on it.
Oh, I'm not sure what's happening. Just give me a second. Better now? Not quite. All right, I'm gonna mute myself in a second. I just would like to ask you the question, Nigel, around the proportionate risk assessment tool that you developed in partnership between the IAA and the IAIS, and how this then exemplifies the evolution of existing supervisory tools to actually introduce a form of discretion from the regulator's perspective. So not having to actually change regulations or to go about a process that can be quite protracted, but actually to adapt the existing supervisory processes to keep this need to be agile in mind. And then I'll mute myself and then hopefully the clicking will stop. Apologies.
Great, thanks, Nicola. Yeah, I'm unmuted. Yeah, so I think maybe just to start off by trying to just give a very brief overview of this risk assessment tool that Nicola has referred to, which I was part of the team that developed it. So a bit of a tough challenge to summarize something that we train on for a 2-day course effectively in just a few minutes here, but there are essentially 3 key areas or parts to the tool. The first part is all about identifying risks and ranking them. The second part is then about finding potential ways of reducing the key risks that are identified. And third is then about managing those risks going forward. So on the identifying side of things, the first step effectively, the tool provides a nice structured or facilitates a structured approach. It doesn't do the work for you. You obviously need to do it yourself. It's simply a tool. But a structured approach to identifying individual risks, ranking or prioritizing those risks, and then also assessing what obviously what level of risk there is within those risks. So how extreme or how low the risks are, which is part of the prioritization process, and then aggregate into an overall level of risk, a kind of portfolio view. So if you were applying the tool at a product level, that you would look at individual risks related to things like data, the vulnerability of the target market that I think Elias mentioned has been quite a key thing to consider in certain circumstances. Things like operational capabilities, risks, the skills that you have internally and so on. And you'll be identifying risks out of all those various areas, and you can then aggregate, you would rank them. So you'd see which are the more important risks, and you aggregate them up to an overall view. Once you've done that, then looking at ways of reducing the risks, you can go back to the key risks, the high risks that you've identified, decide on various actions that you can take, and then make an assessment of how your risk for that particular level of risk for that particular factor would reduce, and see how your aggregate risk reduces. And then on the managing the risk sides, well, risks are essentially forward-looking. You don't know now whether a risk will materialize or not in future. And I think even more importantly, you don't know whether the planned actions that you're going to take to reduce the risk, if it does materialize, whether they'll actually have the desired outcomes. So the tool, essentially you use the tool in this third step to reassess the risks at some point in future. And you should be doing it at regular intervals, a kind of control cycle, I guess. Understanding, are those mitigating actions that you are taking, are they actually having the impact of reducing risk to the level that you want it reduced to? Are there any new risks emerging? Are some of those old risks that you've identified, have they reduced? Have they increased? So you need to do these things on a regular basis and manage your risks proactively, effectively. And maybe just a very simplistic example to illustrate this. Let's say in the context of a new product that's being developed and put forward to a supervisor for approval. Let's take, for example, a new mobile insurance product. The supervisor can perform the initial assessment, and the overall assessment may come out as being a bit too high for the supervisor to be comfortable with the product being launched. It can go back and look at the prioritized risks, see that maybe one of the key drivers there could be, for instance, the risk of low customer awareness of the covers that they got because the product's embedded in the mobile services that are being provided. So maybe you're really concerned that a lot of valid claims will just go unpaid because people are not aware of the cover. Supervisor and insurer can have their good discussion, agree on an intervention that needs to be taken, and something like as simple as sending out regular SMS communications to all customers who are registered for the service. So the supervisor would then approve the pilot, and in 6 months or whatever time frame would be reasonable, reassess the risks. And there would be a focus there on those key risks that you identified, like the risk of low consumer awareness. And you need to be clear that upfront, what kind of indicators that you'd want to monitor to make sure that the risks are reasonably managed. So for example, claims ratio could be one where if your claims ratio is low, it could illustrate that, could illustrate low awareness amongst other things. So ultimately the tool is essentially a risk management tool that helps identify your main risks and then manage them. And I think, Nicola, then specifically going to your question of how can that be brought in to something like the product approval process, for example, without significant changes to the regulatory framework. Sorry, getting a bit tongue-tied on that one. So I think essentially these kind of things don't need any sort of major changes to your regulations, to the legislative framework and so on. It essentially needs to looking at what your current processes are and where those processes can be improved. And I think Protazio will probably talk a bit about it, but we have sat down with RA a few years ago to help them build in this kind of tool into that product approval process, essentially to, I guess, give them the comfort that they now have the process in place and the skills in place to assess the risks of innovations appropriately, and then to take the appropriate actions around that. And that was done without having, essentially having to train, to assess the process. No changes required to various legislation, regulations, etc. So it can be done in a fairly quick, on a fairly quick timeline. And it provides, I think, as I say, that confidence that you've got the capabilities of identifying risks and of managing those risks, which is really at the core of, I guess, any risk-based supervisory approach.
Thanks very much, Nigel. I think you've already alluded to wanting to hear from Protazio about what the IRA in Uganda's experience has been with implementing this tool and with how it has changed your product approval process without necessarily requiring large-scale regulatory changes. So in terms of helping you to accommodate new innovations and to strike this balance. And just apologies again for my sound. I'm glad to see that it's better now. Thank you. Over to you, Protazio.
Okay, thank you very much, Nicola, and thank you, Niger, for that elaborate preamble to my answer, and I will not repeat what you have mentioned. Prior to this tool, and I remember I mentioned to Niger one time that I think product approval was at IRA was a one-man's activity, where the head of technical would assign an officer to look at a submission and either say it's okay or it's not okay. It was most likely that if this product would be given to another officer, probably the assessment would be different because there was no structured way of handling this. Now, following the training and the development of the tool, domestication of the tool, we instituted a committee. Currently, we have a product approval committee. So this helps to neutralize extremes in terms of decision-making. And it's a committee of 4 members identified from different departments. We have somebody from legal to bring in the legal view, another one from technical, somebody from market development, so that they give a product different perspectives. And by the time this product is approved, then it's a product that can stand the test of time. But we have also shared this same tool with the players, so that by the time they submit the product, they have also done their own assessment. And this has resulted into some products not even reaching our table. This has reduced the work before us, because once they subject the products, the tool that Niger has explained, and they realize that the risk is too high to be even submitted to the regulator, they first work on the risk aspects, ensure that the risk has reduced, then they are able to submit to the regulator. So they are doing a lot of work that would actually be doing. It has increased uncertainty. They can tell whether the product will be approved or it will meet some bit of resistance. With this tool, we are able to return some products with clear comments on the areas that need improvement. So what I can say, and this we have done without any change in the regulation, because product approval is already enshrined in the Insurance Act as part of our mandate, because no product goes to the market unless it has been approved by the authority. So it has not necessitated any change in the regulation. Within the existing framework, we have been able to streamline the product approval process. Now, because of that, number one, I can say, number one, the authority resources have been saved in terms of time. Some products do not come here. In the past, every idea, every thought would reach here for us to look at, then you end up spending 2 days, 3 days reviewing, then you send it back because it does not pass. Currently, most of the products which come through have already been subjected to a prior review by the players themselves, and this makes our work a little easier. But also too, the seeming friction between us and the players, because they are also able to see, since the process now is very structured. If I say the product does not pass because of A, B, C, and D, and you follow the process, you also see clearly that indeed the decision arrived at is a scientific decision, so much that any other person wouldn't have had a different view. Sometimes we have given conditional approval. In the past, it was either approved or not approved. But now we can approve a product and give time within which to manage certain risks, and give us reports, like quarterly reports on how certain risks are being managed, so that after a certain time, we can remove the condition and give a full approval. So that one has also given us leverage to provide some conditional approval, not to discourage innovation, because all this is to discourage, is to encourage and promote innovation. So to avoid the extremes of yes and no, we now have also leverage of saying, work on this, keep us updated until such a time when we feel we are comfortable to give a full scope approval. So the tool is very helpful. Before, as a product is being submitted, we require that the insurer submits the product with a tool field, the risk matrix, so that we are able to know, to see from the insurer's perspective, how do they look at the risk? Then from our perspective, do we agree or there are changes? And when we look at both the insurer side and the regulator side, we are happy that we come up with a position which we are more comfortable with. So in terms of value addition, yes, there has been a lot of value addition, because now there is more ability to understand a product 360 degree. With the matrix which we have, we look at the product from different angles. So we are glad that our capacity to understand the products which are approved has been enhanced. Number two, there has been significant reduction in subjectivity. It cannot be eliminated because, you know, risk is a perception and it varies from individual to individual. But because they are pointers, and the fact that you have many people in the committee and you get the average ranking of all, that tends to eliminate the seeming subjectivity. But three, and most importantly, the tool has empowered the players, that they are able to assess their products even before they are submitted for regulatory review and approval. In terms of challenge, of course, this is a new thing. I think this is our second or third year of application. So initially, some people did not appreciate it and they thought it was going to take a lot of time. You do look at a product, you do risk assessment, you fill in those color codes, then finally you have to give an approval. They thought it was time consuming. So it takes time for people to adopt changes, typical of any innovation. So that was the challenge. And I think even initially here, some people wanted to reject it. But because there were some converted minds, we pushed it through, and it is now an adopted practice. Then, of course, if something is very urgent, again, from the innovation point of view, some people want their products submitted today and approved today, which may not be the case, especially when you want some additional information. So some people probably think that there is some reduction in speed at which approvals are given, but as a regulator, we are happy to spend that additional time so that the approval we give can stand the test of time. That has been the experience for Uganda so far.
Thank you very much, Protazio. Thank you for sharing. So we'll have the framework back on the screen in a couple of seconds. One of the third category that I think we're all aware of is around how regulators can respond to new and emerging risks. But I want us to move on now to the role that monitoring can play, because I think it's sometimes quite an issue or a sore point perhaps between supervisors and industry, because essentially what you measure is then what determines what the targets are, what the KPIs are. So the starting point for adopting a more holistic regulating for innovation point of view, at least from the research that we've done, is to actually expand the extent to which indicators are monitored and are collected. So one of the key examples of single indicators that are currently being tracked across supervisory authorities is penetration, for example, which unfortunately cannot, due to its very nature, capture all of the various aspects that we associate with insurance market development. And beyond that, it's not fully within the insurance sector's control. So from that perspective, then, I'd like to hand over now to Hughlin and to ask you a little bit more about the supervisory key performance indicators lexicon. If you could tell us a bit more about its objectives and what it covers. Thank you.
Thanks, Nicola. So this is a project that the ICII and SENFRI are currently working on together. And Nicola, of course, you are part of this team yourself. And so what we've been doing for the last 2 years is to work with a group of 7 sub-Saharan African insurance supervisors, what we call the steering group, to sort of develop a set of reference materials to support sub-Saharan African supervisors in sort of collecting and analyzing data and key performance indicators more effectively to support their supervisory roles and sort of expanding supervisory mandates. And sort of the problem statements or the reason why we started on this project is that quite a number of SSA supervisors highlighted that they feel they currently sort of lack a structured way to monitor and sort of track some of these risks and benefits to market development that I think all the panelists have been talking about. And that's why I very much like the idea of what Nigel and Protazio you said about how you use of the tool to sort of structure the conversation and reduce subjectivity between industry and supervisor on what are the, really the risks when it comes to new innovation. So it's that kind of problem statement that we're looking at. So for example, in prudential supervision, what benchmarks do you use in KPIs? In conduct supervision, what are the KPIs that you should use to measure consumer protection in the first place? And in market development, even more sort of one step more abstract than that, what do we mean by market development in the first place? And then how do we measure that? So these are some of the questions that we're working on together with the group, and what we've come up with in terms of the product is firstly, as you say, the KPI lexicon. This is basically a list of key indicators, definitions, formulas set within a clear conceptual framework covering 4 pillars. So prudential, market conduct, market developments, and the SDGs, or insurance and sustainable development. It's basically a kind of KPI dictionary, so to speak, for insurance supervisors. And what we're currently finalizing at the moment is a set of sort of handbooks providing technical and practical guidance to support usage of these KPIs. And these reference materials are very much based on the experience and priorities of the steering group, as well as sort of drawing on global practices we've seen among IIS, the IIS supervisory community. So sort of more specifically within the market development pillar and innovation and so on, I would say the key purpose of this toolkit is to help supervisors sort of measure market developments in a more holistic way. So as we alluded to a number of times, it's not just about insurance penetration, but it's got a lot more components to that. So within the market development pillar, it sets out the different areas that make up development. So penetration, innovation, inclusiveness and access, the regulatory environments, the insurance sector talent pool, And what the handbook does is to sort of take supervisors step by step to first sort of go through, okay, firstly, sort of deliberate among yourselves and articulate concretely within your organization what your market development goals are. And then secondly, refer to this dictionary, this KPI lexicon, and select the necessary KPIs that you feel reflects your goals. And then thirdly, consider the feasibility and practical factors. So which KPIs are most practical and feasible to measure, considering what information you already have access to, what the industry is already tracking, what the industry has the capacity or doesn't have the capacity to track, and sort of build a core set of indicators based on that you would then track regularly. And then finally, feed that into your internal policy deliberations, report internally to management, report to policymakers, identify gaps, and use this as a basis for engagement with the industry when you discuss potential insurance solutions to address some of the market development challenges that you're identifying. And I think for this, I really want to sort of go back to what Nigel said earlier about how I think what's really good about sort of having more data and more structure to these conversations is that it really gives supervisors more confidence to really assess the situation and identify the problem and then therefore come up with a solution to address it. Because I mean, if the evidence is there, it's quite hard to argue with it, right? And I think it's a lot more powerful to take a set of data and go to the industry and say, look, we are showing you here that the product mix in our jurisdiction has been the same for the last 20 years. It's only got these products, nothing's changed. We launched the mobile insurance framework 5 years ago, and we only see one new mobile insurance product. Claims ratios are terrible. What do you have to say about that? So, you know, the idea is to kind of put this big picture together and yeah, allow more constructive conversations that way. And I think the last sort of point to mention here is that because it's got sort of 4 pillars, I think the idea is that supervisors can also sort of use this to look at benefits versus the risk as well. So you not only just measure what you're achieving with in sort of a market development sense, but you also cross-check to the market conduct and the prudential pillar to sort of identify, you know, potential risks in a more balanced way as well. And I think here we see a lot of complementarities with the tool that Protazio and Nigel were talking about.
Thank you. Thanks very much, Yulin. I'm aware of time, and I see we already have a couple of questions in the Q&A session. So I'd just like to conclude by saying, you know, it's clear across these range of tools and across the range of initiatives that the panelists have been discussing today, that implementing regulating for innovation successfully ultimately depends on the commitment of the regulator to see this process through. So to monitor the trends, as Yulin has mentioned, to adapt, as Elias, you've spoken about the need to be agile, and to essentially be willing to change and develop and grow as necessary. So I'd just like to pose this last question to all the panelists before we dive into the Q&A session, which is, and I know, Nigel, you've already spoken to this even at the start of the session, but what would be your advice to insurance supervisors seeking to support responsible innovation in their markets? And then what is the role that industry or the private sector can play in this particular instance? I think, Elias, maybe you can start us off.
Right, thank you very much. My response will be quite brief. One thing that I want to mention is that there's no blanket approach to applying these particular responses or I would say regulations in the jurisdictions. So I would basically advocate that each and every regulator must be able to come up with a response that will be able to address the challenges that they are facing, and look at it in 3 ways. And particularly, the reason why I'm saying that there's no blanket approach. The first thing is that there are those particular responses that they'll just apply using the existing framework to support the new innovation. So rather than just thinking about, we've seen country XYZ doing this particular thing, you just need to check within your regulatory parameter, are there any components that would basically apply to enable innovations to come into into perspective. So in that particular case, then you might not need to really change any of your regulatory framework requirements, but in a way to tweak those particular requirements to support these innovations. The second component that I'll talk about, basically looking at the reason I'm saying there's no blanket approach to innovations, is adjusting the existing regulations to accommodate the new entrants, or maybe re-engineer the existing processes that will enable the regulator to adopt or basically to allow these particular new innovations to come into that particular place. Now, the last thing that I would want to bring into perspective is creation. So there are other innovations that require the regulator to create new frameworks or regulations to support these new particular activities. And that will mean that they need to look at what instruments we really need to create. Is it a guideline? Is it a regulation? Do we really need to insert a new clause within the Insurance Act? So all that needs to be thought about. And again, that will be extended through what I did mention earlier, what we term as the regulatory parameters. How far can our mandate reach? So just to summarize this, there's no blanket approach to innovation. You need to look at what is currently existing in your marketplace. You can either apply what is currently existing, you can adjust what is existing, or you can create what might support you as a regulator. Thank you very much.
Thanks very much, Elias. And then turning to you, Protazio, what do you see the role of industry being? You know, now we've heard from Elias what the regulators should do, but from your perspective, what should industry do, and what role do they play in enabling innovation?
Okay, thank you very much, and thanks, Elias. Maybe just to add on Elias's point, because I sit also with the regulator here, I know I have a view that innovation is more of a public good than a private good, in which case the regulators, being public institutions, should play a key role. And I think we need to be very proactive in terms of supporting innovation. And if I looked at the regulator's budget, I should see a budget clearly highlighted for supporting sector innovation. Because if innovation is not incentivized, chances are very high that they will be very slow, if any. I thought I should add that. And in Uganda, we've started some interventions in that regard. Every year we hold an annual innovation award because we want to encourage people to think innovation. And we think if we have that running all through, then they will think about that and they will be motivated to do the same. Then two, the issue of communication and accessibility to the regulator. It should be open door. You know, innovators are very impatient. They don't want to be told that, you know, we work from 8 to 5 and blah, blah. So open door access. So channels to the regulator and to information should be as open as possible. And thirdly, we should be predictable. The regulatory framework should be that predictable so that people can predict and anticipate what it really takes. Now, to get to your question directly, the industry players need to have innovation as part of their strategy, because it is clear, especially with changing times, with competition. If you look at any insurance industry players' strategic plan and there is no innovation strategy, then chances are very high that that company may not stand for the next 5 years, because things are changing. Everything seems to be changing. So innovation is supposed to be at the center of the strategy of every insurance player, and regulators can motivate that, because one of the things that we look at is the business plan of these different players. So to what extent is the issue of innovation addressed? So it can also be motivated from the regulatory point of view, but it is innovation innovation. I remember I attended one conference where the theme was innovate or die. It is now more clear than ever that any company not willing to innovate will surely die. So to avoid dying, innovation should be at the center of the strategy of every insurance player. That's my view.
Thanks very much, Protazio. I think you, Lynn, maybe turning to you now. I see you've been answering some of the questions in the chat, and I hope we can get to some of those. But I would like to hear from you first.
Thanks, Nicholas. So I think for me, the biggest takeaway from this whole issue is that I feel supervisors, if you're talking about responsible innovation, I think insurance supervisors themselves need to be concretely clear on what kind of innovation they want to see coming up from the market and communicate this as explicitly as possible to the industry to give them sort of steer as well. There's an interesting question in the chat, I think, about how a supervisor can measure the success of a regulatory sandbox. And there's a report from the UK FCA from a few years ago, which I think is really interesting because what they did was to basically sort of set out to the objectives of the sandbox when they rolled it out, and then sort of have a discussion around the data against these objectives that they've set up in the beginning. And so things like how many more people have access to financial services, what are the new business models and technologies that have been introduced in the market, what are the new efficiencies. So I think firstly, I'm very much about the idea of setting out clear direction to the innovation that supervisors want to see in the market, and then secondly, then only supervisors only supervisors can sort of measure the success of the initiatives that they roll out to encourage innovation.
Thanks very much, Yulin, and also for tackling that question in the chat. Nigel, I'm not sure whether there's anything you wanted to add on what industry can do in addition to the answer you gave right at the start of I think you saw how this session was going to unfold and you started answering right from the start. So maybe if there is anything else you'd like to add from that perspective.
Maybe just to almost just echo something that Protazio said, that supervisors need to be open. I think, like I said right at the start, industry needs to be open as well. It cuts both ways. So don't, when you approach the supervisor, be open about what you're approaching them with. Don't try and hide things from the supervisor. I've seen a bit of that in my past as well.
Thanks very much. Thanks, Nigel. Then I see there are a couple of questions in the chat. I want to encourage all participants to add questions in the Q&A session and not actually in the chat box. I'm wondering whether any of these, so Elias, Protazio, whether one of you could perhaps weigh in on the growth of new regional players who are not insurance companies, but could operate as such. So whether there's anything from your side in terms of, so you spoke earlier about the need for collaboration and cooperation among different regulatory entities. So I was wondering maybe, Elias, if you have something to add there.
Yeah, thanks a lot. Again, maybe just to re-emphasize, one of the key things is that particularly for an operator or a company is operating in Africa, there are a couple of components that they kind of face, and also the regulator on the same wavelength is faced by a number of challenges, whereby you'll get that an institution that might not be within the purview of insurance would be providing services that tend to look like insurance, and it's not that they tend to look like insurance, but they do provide insurance in a traditional channel and risks. And one of the key things that will happen is that they might be able to approach the regulator that there's this particular component that we have, and we would want to see how we could scale it up. Now, with that, then the regulator is basically faced with a very big challenge, whereby you are looking at ways in which this particular company must respond or must adhere to prudential standards, and you don't want to create any imbalance. You don't want to create circumstances whereby we can talk about regulatory arbitrages that might affect the entire market ecosystem. So the regulators to again come up in a way to manage this particular issue that basically knocks to their door. So what we've seen and in a number of countries, for instance, in Ghana, we've seen licenses being given to companies that we call them TSPs, technology service providers, within that particular jurisdiction. We've seen also various regulators across the continent currently are coming up with the microinsurance regulations, and within that, then you will be able to see that it basically allows some companies in our nature that tend to address some of the risks that are highly exposed to African citizens to be addressed in that particular wavelength. So there are a number of ways that regulators are trying to kind of enable these particular companies to get into their purview to protect the consumers or to protect those particular policies. At the same time, to ensure that the integrity of market system is also there too. Now, there's also quite an interesting question that I've seen in the chat, whereby the question was that how then do we how do you basically manage the budgetary support to manage these issues of market innovations? Now, we've seen regulators, and definitely maybe Protazo will mention, is that these for regulators to be able to support innovations, they need also to be able to put some resources to manage that. Basically, you cannot be an innovator, a regulator that is going to address and manage future innovations without putting any form of resource. I'll give an example of Kenya, the Insurance Regulatory Authority of Kenya. They did create what we call the Bima Lab, basically a platform that enables innovators and insurtechs to come into an ecosystem, to learn, to be mentored, and also to meet with potential partners for the purposes of that particular insurtech being supported for scale. So ideally, that requires resources. It requires human resources. It requires monetary resources. So there is need to budget. And again, I know Protazo will be able to confirm what regulator in Uganda has been doing in terms of supporting these innovations. But also importantly, as FSD, we've been supporting a number of regulators to issues that do tend to support innovation within the ecosystem. For instance, in the Kenyan second Bima Lab process, FSD Africa has gone ahead and has managed to provide both monetary and technical support for that particular project. We are looking into getting to other countries in Africa just to support innovations and to see how then these particular approaches could be adopted with an intention of increasing financial inclusion. Thank you.
Thank you very much, Elias. I have to apologize because we have unfortunately run out of time for this session, and I see there are more questions and there's more conversation to be had and more responses to be given. But you'll see Dirk has posted in the chat the virtual coffee session happening afterwards. So I'd like to just thank everyone for your time. Thank you for your inputs. It's been a very interesting conversation. I really appreciate it. And then I'd like to hand over to you, Dirk, to close the session. Thank you.
Thank you, Nicola. Thank you, dear panelists and participants, for that very interesting discussion. It's good to hear that regulators are open to adjust their regulation towards innovation. We have seen announcements of more sandbox approaches, so that's a well-needed development. So as I said, join us for a virtual coffee break over the next 30 minutes, and then do not miss to join us for the very interesting Outlook session and the closing of this year's ICII 2021. See you soon. Bye-bye.